Okay, welcome to First Draft Live. I'm Mark Bonner, BizNow's editor-in-chief, coming to you live from New York. It's Friday, November 14th, coming to you just days after the federal government finally powered back on. And no, this is not a victory lap today. This is the hangover show. After 43 days of paralysis, the longest shutdown in U.S. history, the lights are once again back on in Washington. But the economy isn't the one we switched off in early October. Up to $14 billion in output have been permanently erased. The country has sustained a major GDP hit, basically deleting a mid-sized U.S. city from the map. 6.7 million empty hotel room nights, 42 million Americans still waiting on SNAP dollars that anchor half the country's most resilient retail, and 1.25 million federal workers tightening belts heading into the holidays. So yes, technically the shutdown is over, but emotionally, politically, economically, well, the system designed to stabilize the country just reminded everyone how quickly it can destabilize it. And don't look now, but sabers are already rattling about another shutdown in January. HUD's multifamily pipeline is jammed. GSA leasing is weeks from full speed. Federal contractors are triaging cash flow. And the statistical blackout has left underwriting and valuations drifting in what Jay Powell calls fog. That's the real story. Not that Washington reopened, but that it reopened back into uncertainty, something CRE has been battling all year. So how's Survive to 25 going, y'all? How about Bliss in 26? Well, we're going to see. And that's exactly why we asked today's guest to join us. Few people see the interplay between macro shock and real estate reality more clearly than Michael Episcope, co-CEO of Origin Investments, a firm that's built an investment strategy around discipline, downside protection, and reading markets when they're at their murkiest. He's one of the sharpest voices I know on how capital behaves when this political system goes off the rails and where opportunity emerges when everyone else pulls back. Michael, welcome to First Draft Live.
Thank you for having me, Mark. And I was just thinking as you were talking, the last time I was on here was the big shutdown during COVID. And here I am back in another shutdown, about 40% of the country. So it's kind of poetic.
It is poetic. And by the way, just for our listeners and our viewers who don't know, Michael is referring to the pandemic, and Michael was our first guest ever on BizNow's first webinar ever. Another moment where we found the economy in dire straits, and yet here we are again. So, Michael, let's get into it. What does a 6-week federal freeze reveal about the fragility of the U.S. economy right now, and how are you navigating it from your perspective?
Yeah, it's a great question. I mean, I think what it reveals more than anything is the dysfunctionality of our political environment. And that is kind of the elephant in the room. I think what's happened over the last 43 days, as you put it, it's the longest shutdown in history. It's somewhere between annoying and tragic. And if you look at the 800,000 federal workers that were furloughed, the food lines have never been more jammed, food pantries. You have people who can't pay rent, living paycheck to paycheck, having to pick up other work. That's tragic. That's absolutely tragic. And it's 100% um, in control of the politicians, right? This should have never happened. And then you have, companies like ours. We were launching our interval fund, and we were at the 1 inch line with the SEC, and that's delayed. We don't know now that we're going to be opening back up whether we're going to start at the 1 inch line or be back at the 50-yard line, but we will be open. So that's more annoying. But it is impacting, permanently what's going on in the economy. And it's just wiping out growth that we just don't need to. And so, like, this political dysfunction is unsettling. I think the elephant in the room is really the government debt, the government dysfunctionality, the things that we're not addressing. This is like a sideshow to everything going on. And so, like, yes, there's a lot of ripple effect. I think you named a lot of them, but for us, it's it's a speed bump. It's certainly not like it was in COVID, but there's a lot of ripple effects that are happening, and it's kind of similar to COVID in the sense that you have the shutdown, and you're going to have a permanent loss to the economy, but then some of that is going to show up in early 2026.
I mean, it's not just a speed bump, though, Michael. It's another speed bump. There have
Yeah.
been a lot of speed bumps this year in the U.S. economy for a whole variety of reasons. Is this just another moment that commercial real estate has to absorb? Is this par for the course at this point, this deep in the year, now looking into 2026? Or is this permanent structural dent in sentiment and pricing from your perspective?
I think it's a little bit of both. I think for some, you just have to roll with the punches and do it. And you're right. There's a lot of speed bumps, especially over the last few years. It feels like we've been operating on a street with nothing but speed bumps, and we're waiting for kind of a clear road ahead of us so we can put the pedal to the metal. And we all are looking at 2026, some of the multifamily supply getting cleaned up, growth coming back into the market, and some normalcy. So I do think, though, structurally, we're not in the DC or Metro or Northeast, and we're not as impacted by a lot of these government shutdowns. But some of the delinquencies, I mean, you're talking about 10 to 15% delinquencies, vacancies rising. You sort of have to rethink your strategy if you're in those markets and you're building and you have a large presence there, because this isn't going to stop. They're not taking care of the debt to GDP problem. I mean, this whole shutdown was about appropriations, but next year we're going to have to deal with this debt ceiling again. And when you look at that, if this becomes another stalemate, if the government shuts down, they're talking about this happening again in January. It's going to be very hard to be an owner of multifamily real estate in any of the Eastern Seaboard, because it's so connected to what's happening with the government.
And yeah, we're seeing multifamily REITs suffering right now on that front, and so that's a leading indicator of some pain that's either there right now or coming to a theater near you. Let's talk about capital markets for a second. Already wary. Now they're second guessing everything all over again. Transaction volume did pop in September, but confidence, not comps, I think is the real currency here. Liquidity typically lags a shock like this by 1 or 2 quarters. So now we're into 2026. And this one wasn't just a shock, it was a statistical blackout, right? The White House said yesterday that the jobs data from, I believe, October, permanently gone. We'll never see it. Poof, right? How do you deal with that blackout? I mean, can you rebuild it in the aggregate with private sources? Can you sustain a blackout like that, Michael? Like, what's your visibility into this, and how is this affecting your decision making?
So we're not as impacted by the monthly release of government data, because in real estate, you're making 3, 5, 10-year, 20-year bets on real estate. So you really have to look at the macro. That's why I was talking about, if you're in DC and you're in Maryland, you have to rethink your strategy, because ultimately what matters in investing is that you're in a good asset class, B, you're in a good market, and C, you have a great location as well, and a good asset. And so, like, we think about it in terms of that. So missing 1 or 2 quarters of BLS data doesn't make a difference to us. When we're looking at more the global picture, if the government continues to operate at a dysfunctional level and we see unemployment start to rise and delinquencies and they start to leak into other cities we're in, then we're going to have to start rethinking our sort of macro thesis here. But with real estate, it's very different than if you're looking at stocks, bonds, liquid assets, because you're making long-term bets here. So again, it's more annoying not having the BLS data, but it's less impactful for groups like ours. We're not looking at the month to month. We're looking out on the horizon.
Right, but you're making decisions now, or next week, or next month, or in January, right? We just went through this speed bump, which we're going to call the longest shutdown in American history. We've had the other speed bumps that we've talked about. And then you got this other thing happening here, which is another shutdown maybe in January, right? And if you didn't believe that it couldn't happen, we're now 43 days into the longest one that has ever happened in this country. So it could happen again in January. Both Democrats and Republicans are unafraid to test each other on these fronts. So all of a sudden, 2026 is even murkier. What's the real timeline here before deal flow normalizes in your mind, Michael? And when do you make the decision? Are you now making a decision today, between now and the end of the year, or are you going to wait for January and see what happens on Capitol Hill?
We'll continue to make decisions. We're not going to, put any big bets on right now, because you're right. I mean, the likelihood is that there is another government stalemate, that there's a shutdown at some point. I mean, I don't know why we would think otherwise. And I think the real issue here can be just a loss of confidence in the U.S. economy. We're starting to see that show up in interest rates, and again, it comes back to debt dysfunctionality, and we've seen a lot of selling of U.S. Treasuries. The new normal seems to be 4.1, 4.2. We briefly went under 4%. We were cheering for about a week, and then all of a sudden we creep back up. And some of this, who knows if this is accurate, is attributable to this government shutdown that we saw kind of a 15 basis point spike in the interest rate. So I think we have to be wary about the things that really impact multifamily real estate and the variables there, which is the growth of rent, vacancy, the job market, interest rates. To that extent, we will get through this like we have everything else, but it is impacting. I mean, when developers have to carry properties for another month, 2 months, 3 months, 4 months, you're talking about another, 5, 6, 7% in carry costs. And some people are better equipped, better balance sheets, not using a lot of leverage to withstand some of these issues. And then other people have business plans that are more price perfection, and they're going to be on the edge. And so, like, we always look at the kind of the dystopian view when things are happening here. This could lead to other opportunities, certainly buying opportunities next year for the market, and people who just like abandoned projects, don't want to get in, can't continue to float their projects in the wake of a government shutdown, or just say, Uncle, I'm not going to deal with this kind of unknown in my life.
How important is this next Fed meeting to you in your world?
Not as important as you think, because there's two things. The Fed only has control over the short end of the curve, and we've seen the long end is going to do what it wants, and the long end is really it is priced based on supply and demand of our treasuries, our risk as the U.S. government, and there's not much they can do. So they can lower rates to even 2%, and the long end could go to 5 or 6%. You didn't really see a huge impact on the long end when the Fed lowered rates. I think if anything, it does from an investor perspective. If they're no longer earning an interest rate, because there's so much money caught up right now in money market accounts, and as long as investors are getting 4.5, 5% on a pre-tax basis in those accounts, they're pretty happy. If they start earning 1 or 2, they're going to start looking at risk assets more and more. So the biggest thing we saw, especially in COVID when rates went to zero, is money flooded in, right? And it also helped that the government wrote $7 trillion worth of checks, but that flow has really ceased in multifamily real estate and across real estate, because the cost of capital is just so much higher that if you can't deliver returns in kind of the high teens, you're not going to be able to attract capital to your deals.
Why does the industry obsess over interest rates? I mean,
Look,
is this media hype
no,
where this has gotten? Okay,
not
explain.
at all. I mean, real estate is a leverage game, and everybody uses real estate, and leverage is a good thing, right? Used in moderation. And so, like, it impacts your cost of debt, it impacts your ultimate cash flow, right? In deals, and then it impacts your valuation methodology, because there is a correlation between your interest rates and cap rates. At times they become disassociated with one another, but it's one of the leading indicators. And when you look at cap rates to treasuries, that's a great forward-looking indicator to the investment performance of real estate going forward. So when that spread widens, meaning your cap rates are much, much higher than your interest rates, that's actually a good sign. So you see that during distress times where cap rates might be 6, 7%, but your borrowing costs are 4%. That is a phenomenal time. Today, you've got 100, maybe 120 basis point spread between cap rates and treasuries. I would say it's good. It's not like you're not running away from it and you're not running to it right now. It's probably going to achieve historical, decent averages going forward. And I think 26 is going to be a good vintage.
If you're just joining us, this is First Draft Live. We're here with our Origins, Michael Episcope, unpacking where the longest shutdown in U.S. history leaves real estate investors and operators after 6 weeks in the dark. So for the past month, as we've talked about a bit, BLS hasn't published the data the entire market depends on. No CPI, no jobs reports. It's left it without a compass of sorts. Even the Fed is squinting. Investors had to navigate the most opaque macro environment in years, while all this political dysfunction that we're talking about is hung over every assumption. At origin, how do you price risk when the government's data stream disappears? And Michael, I want to frame this as we have a lot of people that are watching this right now who are in the dark. Like, what do you do in these moments when you've got a little bit of lack of visibility into what's happening in the U.S. economy?
Yeah, it's not quite risk off for us. I would say we do have an advantage because we have our own data science team, and a lot of the things you're talking about, the CPI data, the BLS data, things like that. We're not pricing those exactly into our model. Certainly, we're keeping an eye on the macro. A lot of times in real estate, it comes down to the micro location, to the deal economics. So if we're tying something up today, we can sit on that deal for 3, 4, 5, 6 months until that information comes up. I think the challenge is, and we talked about this just a few minutes ago, when you don't have this data, when you start to get a, a kind of a loss in confidence in the market for what people don't know and understand, they start filling in with their own ideas, right? And so you've seen an uptick in the treasuries, and the treasuries are still functioning, they're still operating. And what I'm more concerned about is this a microcosm of what we saw coming out of COVID, where you've had 800,000 workers furloughed for 43 days. They haven't gotten paid. It's taken out. Now they're going to come back into the economy. They're going to get paid. Are we going to suddenly see this inflation spike and have this whole, conversation about is it transitory again? And so like this is volatility we don't need in the market. So we're not, again, completely risk off, but I would say that our parameters for doing deals, and this is really true over the last year and a half, 2 years, is that our margins and our cost of capital has grown much, much higher. And something like this doesn't help. Even we're glad interest rates are coming down or have come down to where they were a year ago, but they're still not where we need them to be. And the government has to get their crap together, so we can see some normalcy in the market.
Yeah, I don't want to be a Debbie Downer, but it seems unlikely, right? I mean, it seems like for at least the next few years, political dysfunction in some shape or form is going to continue. And so that in itself is predictable, right? And I wonder from your end of things, can political dysfunction itself become a quantifiable input in underwriting?
It's a good question, and Mark, the way I would answer that is it is an input in the sense that it's the status quo. And we could have a whole conversation about politics, and you can get me riled up, but I mean, it's one of my sort of hot buttons in looking at the dysfunctionality of Congress right now in the Senate and what's going on. And these are just things that we shouldn't be dealing with, right? The government is supposed to be there to quote unquote, help the U.S. economy, and that's just not happening. And I understand each side has their positions and is digging their heels in that they think they're right, but there's real people being impacted with these decisions. So you can go back. We could have had this conversation 5 years ago, 10 years ago, 15 years ago. I think one thing we can count on is that there will be a dysfunctional government, right? I think the difference today is our debt to GDP is at 125%. We're looking at hitting the debt ceiling of $41 trillion next year. There's going to be another conversation about that. We raised the debt ceiling a few years ago to $41 trillion. We just, threw the stroke of a pen by $5 trillion. So it does feel like there's a lot more political discourse that we have to deal with. But in terms of underwriting, that to me feels like a lot of noise because ultimately your real estate, especially in multifamily, it's going to be rely on jobs and population growth. And that's what we need to think about. And the government needs to be a supporter of those things, not a detractor of those things. And certainly what they've done in this last, kind of 2 months has not helped that. But it's not spread equally because it's certainly going to be felt more on the eastern, coast, the Marylands, the DCs, places like that, than it is, when you're talking about Sunbelt markets. But there's so much of the economy that's tied to the government that nobody's immune right now.
Yeah, and look, and on the consumer level, Americans have been on a roller coaster ride. This 43-day shutdown, it exposed some new challenges on that front. SNAP payments that have been delayed, straining grocery and discount chains, a lot of other retail, unpaid federal workers, that cuts discretionary spending. Tourism has weakened. Maybe it bounces back, maybe it won't. In CRE, the demand side, wobbles show up fast in collections, occupancy, and tenant health, right? Mm-hmm. So how do you think investors should be viewing consumer risk in this political landscape going into early next year?
I one thing I was reading recently is you have to assume that there's going to be lower demand as a result of this government shutdown. You had mentioned SNAP program, yes, and the HUD shutting down. I mean, that also impacted 50,000 families. Section 8 vouchers, things like that. It also pushed out 2,000 multifamily starts a lot. It's going to impact your rent growth. I read that it went from 3.5 to now 2%. That's going to impact underwriting, and it's just going to kill a lot of deals when you look at that because one of the most important variables when you're underwriting these investments is rent growth. And when you go from 3.5, which is sort of a little bit above your normal average down to 2%. And look, not every city is created equally. Some are going to grow at zero, and some are going to grow at five still. But that will come into the calculus and decide which deals get done and which deals don't. And if you're on the margin, you're going to have to scrap your deal or find some cost cutting savings, things like that. But there's trickle effects to this, so that's kind of how we think about it. I mean, it's again these things. This too shall pass. I don't think we said that. I don't know when we were talking about COVID way back when it didn't feel like it was going to pass in the moment. This too shall pass, and we're going to have to deal with it again. But I think we're pretty insulated because of our diversification, southeast, central, and southwest. So that's what we do feel good about. And multifamily is an asset class that is essential. People need shelter; they need a place to live. However, as we've seen, you can always overbuild. We'll be out of this in a few years. And I go back and I reminisce about '08 when we were completely overbuilt on the for sale side. And then 5 or 6 years later, all of a sudden the headlines were, we have a housing shortage. This is cyclical. We'll get through it. We'll get to the other side. And we'll be talking about this in 2 years. Hey, look at all this rent growth. We're on the other side. Look at where multifamily starts are. Demand is outpaced. And so like you can have me back on when those are the headlines.
I can't wait. I can't wait. And just going back to the pandemic, like I'm really glad you brought this up because I think there are some corollaries here. But on the other hand, I could say we're not past the pandemic yet. We're still dealing with the after effects of the pandemic. I don't. The pandemic was way more profound than a 43-day shutdown, right?
Sure.
I mean, so
Yeah.
it's an unfair comparison. But the pandemic permanently altered all sorts of things in society and commerce, and we're still dealing with that shift. And a lot of those things that we took for granted pre 2020 are never going to ever be the same again, right? But to come back down to this moment for a second, like, what do you think are some underappreciated after effects of the longest shutdown in history from a commercial real estate perspective, at least over the next couple of months?
The after effects, what always happens anytime something gets shut down is you create pent up demand in the future. So a lot of these things are going to show up in 2026, and we're going to see, certainly lower GDP this year as a result of it. That's going to probably knock 50 to 100 basis points off of our GDP growth. And next year, some of that will actually show up, and you'll see, hopefully a lot of starts coming in Q1. But I think, when I look at some of the key features, I actually I have this list. It was interesting, like what are the most impactful things, and some of these things, like the U.S. debt ceiling, what's going to happen next year. I think that's the next thing that we have to look towards. That was raised by $5 trillion in July 2025. And you think about the magnitude of that, that's the size of Japan's GDP. It's actually more than that, right? 800,000 federal workers. That's more people than live in San Francisco. The 43 days, the longest shutdown ever. Before that was 22 days. So there's a lot of I think after effects that are going to happen, and people are going to really have to rethink their investment strategy and how these government shutdowns, how the debt, how the government, because there is a possibility, and I wouldn't say it's a possibility. It's a when, not an if. When does the government really have to get the debt under control? We don't know when that's going to happen. We're growing the debt at 6% per year GDP. We know that sustainable is 3%. But if you cut 3% off of that number and you get to that 3%, that is going to have a ripple effect. And where is that going to impact the most? And I think as our debt grows, we have to be cognizant that there will be a reckoning. I don't know if it's austerity, if there's like a healthy reset, or if we're just going to absolutely run off the tracks. But when people ask me, what do I worry about the most? Yes, it is government dysfunction, but it's the government debt just running awry, and it doesn't seem like anybody in Congress, anybody who's in DC right now wants to really do anything about it. And you hear these senators, these congressmen who raise red flags, and they're just met with deaf ears. And you're like, I actually like what he's saying. Why does nobody else, see this? And I know many people, and I'm sure the people listening today agree with me. We see the problem, we see the situation. It's a simple solution, and yet there are so many, kind of hands in the cookie jar, and so many conflicts here that are just not letting us address the problem. And it might have to be, just go off the tracks and then address it. And hopefully Ray Dalio is not right in his, predictions.
If you had to call it right now, what does 2026 look like for the real estate investor who keeps their head while everyone else panics?
I think 2026 is going to be better than 2025. The fundamentals are setting up. I think this is regardless of what happens to the government. There's always an X factor, but a shutdown isn't going to be and it's going to be better than 2024, and it's certainly going to be better than 2023. So the market is starting to show signs of recovery. You have the supply starting to dwindle. You still have one of the biggest challenges in the economy, which is owning is incredibly expensive. Renting is way, way cheaper. So that rent to own gap is fueling demand for rentals. I mean, if you go to Nashville right now and you're renting down there, you're going to get 3 months of free rent. Walk into any multifamily property down there. That will slowly disappear. And I think that, when you look at the demand side, when you look at the supply side, things will start to clear up. The market and the economy has a self-regulating mechanism, and it's the profit incentive. So people have not put a shovel in the ground in 2 years. They see this probably 2.5, maybe even 3 years now. And all that supply cliff is going to happen. It's going to take a while to clean up, the existing supply, get that rented, get rid of this free rent, get back to some normalcy. But I'm optimistic. I don't think this is going to be a V-shaped recovery, but I think you're going to see us, like we've been skipping on the bottom, and I think we're going to start to leave the bottom here. And I think the first place, and for anybody watching, you should start to watch the public REITs, and I think you're going to see them start to go up over the next year.
Okay, Michael, I'm getting the hook from my producers here. That's our show for today. Thank you so much for taking the time.
Thank you for having me, Mark. It's been a pleasure.
If you missed any part of this conversation or want to catch earlier episodes, you'll find every show on biznow.com or in your favorite podcast feed. Just search First Draft Live. We'll be back next week. Until then, this is First Draft Live. Have a great weekend, y'all.